The Australian dollar has had quite a good week, rising above 71 cents for the first time since the 6th of January. Of course, in early January, the Aussie dollar fell steeply from around 73 cents to below 70 cents and towards 68 cents, with a focus on the turmoil in Chinese FX and equity markets. When the Aussie was close to 68 cents, the markets were pricing in a very negative outcome for the Chinese economy. But these fears have eased somewhat in the past few days. China has worked very hard to keep its currency in tight ranges, stabilizing it with considerable success. And Chinese equities, while still somewhat volatile, are not nearly as dramatic as in early January. So the more bearish fears over China have not yet been borne out, and the Aussie dollar has benefited. A recovery in oil prices has also supported the Australian dollar. Now, admittedly, the impact of low oil prices on Australia is quite mixed. Low petrol prices are obviously a positive for consumers and for businesses in Australia. But Australia is a net exporter of energy products, particularly liquefied natural gas. The price of LNG is closely tied to the oil price. So Australia's export values should benefit if oil recovers somewhat and boosts LNG prices along the way. The Australian dollar has also benefited against the US dollar on the outlook for US interest rates. The Federal Reserve held its policy meeting this week. It was not expected to change interest rates, and it didn't. But its wait-and-see policy was taken by markets as pushing out the timing for the next move on interest rates. Weak data has reinforced this expectation, with markets now only pricing in a 14% chance of a rate hike at the March meeting and only one rate hike over the course of 2016. This has undermined the US dollar and benefited the Aussie. In terms of local drivers for the Aussie dollar, there was a bit of a bounce in the Aussie after the Q4 CPI data. While only slightly higher than market expectations, it did pretty much remove any lingering risk of a surprise rate cut from the RBA in February. But inflation was never much of a barrier to the RBA acting on rates again this year. We expect that they will remain fairly upbeat on the growth outlook and therefore keep rates steady over the course of the year, supporting the Australian dollar. However, markets are still leaning towards the chance of another rate cut later this year, with one rate cut being fully priced by September. So there's a limit to how much further support this is likely to provide the Aussie dollar short term. So in the week ahead, we'll get that decision from the RBA along with their quarterly statement on monetary policy. We'll also see readings on building approvals and the trade balance. In terms of the global mood, the Australian dollar may well benefit if Chinese authorities are able to keep their currency and perhaps the equity market as well on a fairly short leash ahead of the Lunar New Year holidays. This should help the Aussie maintain an underlying positive bias towards the top end of a 69 to 72 cent range. We'll speak to you next week.